All right, good afternoon and good morning to everybody. Depending on where you are in the country, we are getting ready to kick off our Investments 201 webinar. Appreciate everybody attending and our two esteemed colleagues and fantastic advisors, Alicia and Zach, which I'll introduce in a moment. Just a quick brief thing about McQueen Financial. Most of you are very familiar with us. We have three main verticals in the company, one being our mergers and valuations team. We're doing both transaction advisory as well as valuation work, MSRs, and consulting and valuation work. Then we have our interest rate risk modeling team and analytics doing ALM reporting and related reports along with CECL reporting. And then we also have our investment advisory team as well, advising on portfolio management as well as alternative portfolio management, doing charitable donation accounts, as well as employee benefit accounts, and then also some OCIO for charitable trusts and foundations for those of you on the call that are on boards of foundations. And please reach out to your advisor for any kind of additional information on that. I'm Craig Cecilia. I'm our Chief Investment Officer at McQueen Financial. And our next slide, our advisors. First senior advisor is Alicia Bradley. She's been with us for in excess of 10 years, does a lot of coaching with employees that come on with portfolio management as well as interest rate risk management. And she also works with clients on these topics as well. Our other presenter is Mr. Zach Whaley. He's also a senior advisor working with clients on asset liability management as well as portfolio management. And he also heads up our alternative portfolio management team for employee benefits and charitable donation accounts. So you guys, thank you so much for being here. We really appreciate it and look forward to all the knowledge you guys want to share with everybody.
I'm excited, Craig. Thank you for having us and thank you for being here yourself.
You betcha. And Alicia, thank you so much.
Absolutely.
Just a little note on administration. There is at the bottom of your screen a chat box. You can chat through there or do Q&A, however you want to do it. As Alicia and Zach present, they're going to do most of all the heavy lifting for today's webinar. I'll be monitoring the questions, and if it's relevant for what we're talking about at the moment, I'll politely squeeze that question into you guys. So, and then if it can wait till the end, I'll have it at the end as well. So please feel free participation. And lastly is today's webinar will be recorded, and we'll be putting it and posting it to our YouTube channel, which we have at McQueen Financial. You can go to our website, you can go into our webinar tab. It'll have this one as well as all of our other historical ones on a lot of different topics. And please, that's a tool for you to audience to share with your other teammates as well as board members for training. So please feel free to leverage that that tool that we have for you. So that's it from an administration standpoint. Alicia and Zach, please take it away.
All right, Craig, thank you so much. All right, so for those of you that have joined us in previous webinars, we recently had a 101, which really just scratched the surface. We talked about high-level strategy, why it's important to have an investment portfolio to begin with, how we might be able to partner with you to accomplish your goals with an investment portfolio. So today we're going to dive even deeper. And we actually referenced 201 a lot in the last webinar, Alicia.
We did.
But now we're here.
We are.
And I'll tell you, I'll set this off by saying it's an exciting time for me to give a little bit of kudos to Alicia, because when I started with McQueen 5 years ago, I basically learned everything from you. And here we are. So it goes full circle.
It sure does, because I learned most of everything I know from Craig.
Here we go. And Craig, I learned from you too, by the way. But all right, what are we going to talk about today? We're going to talk about portfolio diversification. It's really important that we don't put all of our eggs in the proverbial one basket, right? We got multiple baskets, multiple eggs, and we want to be diversified. We're going to talk about different asset classes, and really that's where we're going to dive deep today. We're going to talk about the main asset classes that you could invest in and go pretty deep there. A little bit about portfolio duration if we have time. There's a lot to get to before then. We might be a little bit brief on that. But one of the things you're going to notice in the presentation, there's a lot of data. We're designing this so that you can go back, read this and study it. You can share it with other people in your management, even with your board. So welcome. Thank you for joining us, and let's get going.
Yeah.
So first of all, Alicia, we're going to talk about portfolio diversification.
Yep.
So here's a question. Why do we, it seems kind of obvious, I think we're all taught to diversify, but why is diversification important to this topic?
For a lot of reasons, several of them mentioned here. We want to avoid any sort of concentration in a specific asset class in our portfolio. And this is going to tie into some of the other slides. Every different asset class has different pros and cons. It has a different yield at a different point in time, depending on the economic cycle that we're in. Every asset class yields differently in that cycle. So the shifts in relative value or yield, we want to be able to manage the risk in the portfolio. We don't want a whole portfolio of corporate bonds. They're 100% risk weighted. We get a great return, but from a risk standpoint, it's really risky. We also don't want a whole portfolio of treasury bonds because we lose out on yield when we have a whole portfolio of the same thing. And we want to be able to look at our maturity ladder and our portfolio average life. They go hand in hand, and be able to manage that as a piece of an asset on our balance sheet to offset whatever sort of risk and or short-term or long-term risk we have on the other side of the balance sheet from a lending perspective, and to offset the liabilities as well.
Absolutely. A lot of 101 memories coming up
A
for that
lot
last
of one-on-one, yep.
Yeah, we go pretty deep on that if you want to check that out. But now we have a little bit of a symbol of how we're diversifying within our portfolios, a snippet actually from an investment portfolio that we work with when we work with our clients. So what are we looking at on this page, Alicia?
So the graph there, just a simple chart graph, represents a couple of different asset classes in the portion of the portfolio in which they make up. So we're looking at the asset classes on there. There's 4 specifically listed. So we want to do our portfolio diversification from an asset class standpoint. From a term standpoint, again, going back to that weighted average life, we want to look at the weighted average life of all of our assets from the lending perspective, as well as the balance sheet overall. And then from a time perspective, meaning if you were to call us today and say, hey, I have $10 million to put to work, which if anybody has an extra $10 million, we need to have a different conversation. We don't want to put all of our eggs in one basket in one asset class, but we also don't want to put everything to work at one day. We want to make sure we spread those investments over a period of time, because the value does change in asset classes over time and as that treasury curve ebbs and flows.
The good old averaging in, as they say.
Absolutely.
Absolutely. So, all right, let's go on. We're going to get into specific asset classes, and we'll start with the grandfather of them all, and perhaps the most boring, but important still, the treasury bond.
Yeah, but it's the most basic vanilla, and vanilla is the base flavor for all cakes we're going to bake. So we'll start with our vanilla treasury bonds. What is a treasury bond? It is debt issued by the US Treasury. I love when a definition has the word of what you're trying to define within it. They typically have a fixed coupon and a final stated maturity, so super boring. They are the risk-free benchmark used by the bond world to look at the relative value in other asset classes, because we know that these have no risk. They are explicitly guaranteed by the US government, which is why they have a 0% risk weighting. That risk rating from a bank perspective is how it incorporates into their capital structure. And for the credit unions that opted into risk-based net worth, that's where that 0% risk weighting comes from. So it's just a risk-free benchmark. So when we're looking at every other asset class, we're looking at how does a corporate bond compare to a treasury, given that a corporate bond has significantly more yield. So then when we compare a corporate bond to, let's say, a muni bond, we can look at the spread to the treasury curve on the muni versus a spread to the treasury curve on the corporate and see who has more value. It's our baseline to look at when looking at other asset classes.
Well said, Alicia. And I think the big takeaway for me here is that when we talk about spread, we're often talking about over the treasury, as you just mentioned.
Over the treasury curve. Yep, absolutely.
And what's that weird looking line at the bottom here that looks
that
like
weird looking line that I have done several double takes at when reviewing this presentation? That's our beautiful inverted yield curve. Normally it should be a little bit lower there on the left and shift upwards as it moves to the right. Instead, it looks like it looks like a roller coaster ride. Where you need it to shift back a little bit, it'd be nice if that happens. It's not the point of today's presentation, but you can see that we do have an inversion with the shorter term yields there on the left and longer term yields flat out there on the right.
Absolutely. Okay, so you mentioned some of these things, but what are real pros and cons when we're thinking about treasuries? Do we just never buy them? Is there a time? What are we talking about here?
Well, if we buy too many, Charlie's going to come knocking on our cube wall and ask us what's going on. Not a conversation any of us like to have, but they are the most liquid investment that we can buy. They are pledgeable, whether we're looking at FHLB, if we're looking at the BTFP, if we have to pledge bonds for specific collateral against a project, which happens from time to time, extremely pledgeable because of what they are. We can buy them in $10,000 increments. We can buy them in $10 million increments. So from a piece size perspective, we can fill it across the spectrum. We can get them in any single maturity month we're looking for. When we get out a bit longer, those months become a little more sporadic, but generally 0 to 7 years, there's 2 maturities per month. Again, 0% risk weighted, like we already mentioned. And then on the con side, there's typically no spread. And I say typically because there was a point in time when treasuries yielded more than a couple of other asset classes. It's not the best investment cycle to be looking at, but they typically, because they are a 0% risk-weighted investment in the baseline of what we look at, there isn't a lot of spread on them.
That's funny. We're comparing it to itself.
Yeah, when we compare it to it, again, that's a definite, using a definition.
That's right. All right. So now we're going to go on to the very esoteric certificate of deposit. Not quite. It's pretty much next in line with complexity. So most of us on this call, all of us probably are familiar with these because we issue CDs ourselves as a financial institution, right? We give them to our customers, our members. We give that out, and we can also be purchasers of CDs. And essentially, it's offered by a financial institution at a fixed term and a fixed rate. It's very similar to a treasury in that sense. But they are considered low risk, and the reason is because you want to buy them under the insured limit. For the FDIC and the NCUA, it's both $250,000. They do have a low risk weighting here as well. 20%, not quite zero from the Treasury perspective. And rates are based on institutional deposit needs, and relative value shows up when institution need to raise money. So let me break down what that means. Perfect example is what we saw over the last 2 years. In 2020, when rates fell, institutions like yourselves were flooded with cash. You were not showing the best CD rates out there probably. You didn't need the money, so those rates stayed pretty low. But now, when rates are very high and liquidity is very low, CDs are, you can grab great yields on those because institutions need a lot of money.
Yep.
So the different types of CDs that are out there are primarily, speaking of flavors again, we have 2 flavors here. One is a brokered CD, and this is where you're buying a certificate of deposit through a broker. It's still an institution. You're buying it from a bank or credit union, but it's through a broker. And what that allows is for that investment to have a QSIP. That QSIP makes it marketable. So another way to say this is a marketable certificate of deposit, and it can be sold on the secondary market. And you can really purchase it because you can purchase it from so many different brokers. You have access to a ton of different inventory, a lot of different opportunity out there. If you have access to multiple brokers, you can have that opportunity. And the market value is determined by market conditions. So if you bought a CD today, maybe you buy a 5% CD. If rates fall, we expect them to, by the way, that CD would become more valuable because in the future, maybe they're only issuing 4% CDs. You got a 5%, it's worth some value. On the other hand, though, we have what's called a direct purchase CD, or maybe better said is a non-marketable CD. Now, what I'm talking about here, basically, you're going through typically a platform. You're not calling up a credit union or a bank and saying, hey, can I buy a CD from you? Although that is possible. We're really talking about accessing a platform. At the bottom here, you can see Simply CD and Quick Rate as 2 examples. You're going into the platform, you're buying the CD direct from the bank or credit union. And there's a challenge to that. And they don't have QSIPs. So, Alicia, we've really seen this recently where some of the clients that we work with, they have a lot of these non-marketable CDs and they can't just go sell them.
Right.
Right. So what do we do then? You have to go back, you have to go to the actual issuer and you can say, hey, can I break this CD? Can I get my money back? And you're really at their mercy on whether or not they're going to let you do that.
Right.
So there's pluses and minuses. The plus is, well, we'll actually get to that in a minute when we get to the pros and cons. Here is a look at value across different time frames. And we already mentioned what happened in 2020. That's our yellow line. In 2021, at the bottom here, we can see very low yield. Nobody needed the money. We go to the top line in 2023. There's no money in the system or it's leaving quickly. People need to issue CDs to retain and attract more money. Yields are very high. This is going to ebb and flow. So the pros and the cons. Well, the pros are it's guaranteed if you're under the insured limits. So it's very important to be under the insured limits.
Yep.
And there are high yields up here when liquidity is low. We talked about that a few times. Now the cons are they're very small piece sizes because of that limitation.
Yeah.
At 250. So if you're a larger institution and you have a lot of money to put to work, it's kind of like spending pennies at a time. You're not going to be able to really do that effectively. Now, for smaller institutions, the small piece size doesn't matter that much, the block size. Limited maturity range, if you're looking to buy a CD in the month of May, you're going to be buying a maturity that is also in May, and 2 years from now, 3 years from now, whatever it is. So that's kind of challenging to build a ladder if you have that restriction.
Yep.
Non-pledgeable, when yields are low, there's low yields when liquidity is very high. So a lot to talk about with such a simple asset class, actually.
There is a lot to talk about there. And that rolls us into U.S. agency bonds, which from a complexity standpoint are about the same as treasuries. A U.S. agency bond is simply debt that's issued by a GSE, which is a government-sponsored entity. So Fannie Mae, Freddie Mac, Federal Home Loan Bank. It is an implicit guarantee. So we don't have any guarantee explicitly that we will get our funds back, but it is implicit because they are government bodies. They typically yield a little bit more than treasury options. Unfortunately, the graph on the next page doesn't show that, but typically they do. And again, it depends on the ebb and flow of the cycle that we're in. I've seen agency bonds yield between 10 and 15 basis points over treasuries. I've seen them yield negative to treasuries. I've seen them be equivalent to treasuries. It really just depends on what's going on in the market. They are 20% risk weighted, the same as CDs. So again, there's that complexity there. Where they start to break away from CDs just a little bit is they have can potentially have a lot of optionality. The most common thing we look at when we see agency bonds is we look for bullets. So they have a fixed rate with a final stated maturity. Same thing as a treasury bond, except you get a couple of extra basis points of yield. Where we get into that complexity is when we start to look at the callable bonds. They typically have a final stated maturity. Traditionally, they do have a fixed rate, although variable rate bonds do exist. And then they have a lockout period where the bond is not callable, and then it's callable variable dates after that. I've seen optionality be as simple as it's a one-time call. Maybe it's a 4-year final with a one-time call. I've seen a 4-year final where it's callable in 3 months, and after that 3 months, it's callable continuously, meaning it's callable every single day. We don't see that as much. Typically, we see it quarterly or semi-annually. We also don't see the 1 times or the 2 times quite as often, but all of that optionality brings in negative convexity. That's going to be a different presentation. But there's a lot of things that can change how simple an agency bond can be from vanilla to maybe vanilla with some sprinkles.
Absolutely. A lot going on there. This is what you mentioned a second ago about spreads. How are they looking right now?
They're not looking real great. So the green line is you know what? I think I looked at it wrong. So the blue line is the treasury curve, and then the green line is the agency's curve. I make sure we check that on the other graph so we don't reference it wrong. So the blue line, the treasury curve, the green line being the agency's curve. So there is a little bit of spread there, not a significant amount, but there is some spread there. If we go back to the midst of COVID, we were lucky if we could pick up a basis point or two. And then given the different risk parameter between the two asset classes, the question was, does it make sense to pay a little bit more to earn 2 extra basis points for security that's 20% risk weighted versus 0% risk weighted? Typically, the answer was no, client dependent, obviously. But it is just another piece to the puzzle as to how we diversify our investment holdings and how we build out that maturity ladder.
Right on. So let's talk about pros and cons.
We've covered them all. Super liquid, just as liquid as treasury bonds. They are pledgeable, just like treasury bonds, so we can use them to pledge against various lines of credit, as well as potential different projects. Same thing, large block size. Maybe not as large as a treasury note, because when they do come to market, they are considered a quote unquote issuance, and they come in a specific block size. We've seen smaller pieces come, especially at new issue, if we're looking to build a bond, but they are fairly large. Any month and year. They do typically have a spread to the treasury note. And then the cons there are the optionality. When we're looking at callable bonds or potentially step up bonds, which we didn't really get into, they do have optionality there. So if rates move in one direction or the other, if you're hoping a bond is going to get called and rates don't move in the direction you thought, you may be stuck with it, or vice versa. If rates suddenly move downwards and you were hoping to hold a bond to maturity, it may get called away, and then you have to reinvest it at a lower rate.
You know what, Alicia, what I love about this page is that bullet point that says fill the ladder, because basically every investment is a tool in the toolbox. And sometimes, you know, any given asset class will be better in yield. Right now, CDs are doing great. Yields are strong for all the reasons we already talked about. But what I love agencies is a tool to go fill out a specific part of the ladder.
Absolutely.
And you may know that a certain time, 2 years from now, you have a need for that money, whatever the need might be. It could be so many different reasons. It'd be hard to buy a CD in that particular bucket. We can go buy a big old agency or a treasury, depending where yields are, and use that as a tool to complement what your goals are as an institution. So it's not all just about spread. It's about the flexibility of that asset class.
Absolutely.
All right. One of your favorite topics here.
Yes.
So we'll let you take this one away, Alicia.
All right. Municipal bonds. So a municipal bond is a debt issued by a U.S. state or local municipality. And that bond purpose, or the bond has a purpose. There's couple different kinds of bonds that are issued. They issue that debt. It is bonded. So we have limited tax GO, so the municipality can only raise taxes within the voter approved limit. So I'm sure we've all had some special assessments. I know my school district had a local increase millage a couple of weeks ago. We all had to go vote on that Tuesday because it was a refunding issuance. So limited tax, meaning they can only issue so many mills within the voter approved debt limit. We have unlimited tax, meaning that the municipality does not have to go back to the tax base in order to issue that debt. They can simply go above and beyond those voter approved mills. General obligation bonds, or GO bonds as we refer to them, are 20% risk weighted. And then we have revenue bonds. Revenue bonds are secured by a very specific revenue stream. They're typically project driven. So we've got some water and sewer charges, lease payments, facility revenues. Occasionally we see them for things like parking garages at a new stadium. The bond revenue source is the parking revenue earned by the parking garage that the bond was issued to build. They typically do have a higher credit risk because they are being secured by a specific revenue stream versus taxes, which are ongoing. So because of that, they are 50% risk weighted versus 20% risk weighted. So then within those two categories, we actually break down bonds even further. So say next slide, please. So we've got three different types: taxables at the top, general market in the middle, and bank qualified at the bottom. The majority of what we look at as a firm, regardless of bank or credit union, is the taxable piece. What makes a taxable bond is that the interest income is subject to taxes. Plain and simple. The yields are generally higher to compensate for the fact that you have to pay taxes on that income you can earn. That's where we look at for our credit unions. Banks can get benefits from there as well. The general market piece makes up the largest piece of the market, but it's not a space that we play in because there isn't a significant amount of yield there. Generally, it's a little bit below treasuries. Right now, if you were to look, it's a lot below treasuries. Because of that, we simply don't play in that space. Why would we buy something that has credit risk on it versus a treasury that's 0% risk weighted and implicitly guaranteed? And then the third type is bank qualified tax exempt. So the interest income on a state level and a federal level is typically tax exempt. The difference on a bank qualified versus a BQ or general or taxable or general market is that the issuer itself is limited to $10 million in debt. Anything above and beyond that has to come to market or general market or taxable. And there's a tax advantage. So when we're looking at the yield, we have to tax it up based on the bank's specific tax rate in order to get a taxable equivalent. Right now, from a yield perspective, the shorter end of the market, 7 to 10 years and in, depending on the name, that taxable equivalent is still below treasuries. When we start to get out a little bit higher, there is definitely some spread there. But the BQ space has lacked some value for a few years now. I would love to see it come back anytime. But because of that, we've been playing in the taxable space for those clients who have cash to put to work.
All right. So, we have credit risk and value.
Credit
Let's
risk
talk
and
about
value.
this.
So these tie into our pros and cons. Municipal bonds do have credit risk. There is a risk of default if the issuer cannot make the debt payment. There is no sort of guarantee from the US government because even though the municipality is technically a governmental entity most of the time, not all of the time, there's credit risk there. The city of Detroit, prime example right there. But in order to compensate for that credit risk that we're picking up, we do get a bit of a higher yield on it. Plain and simple.
Very good. So all overall pros and cons, a lot of great information.
Yep. Pros, we talked a little bit about the spread already. There's value there because of the credit risk we're picking up. And the next two kind of go together. You get the ability to support your local area, specifically if you're a bank. There's a lot of BQ munis that come to market here in the state of Michigan, and we look at them on a case-by-case basis. If you're not a bank, even if you're just a credit union or a bank looking to diversify your assets, generally the majority of your loan portfolio is going to be concentrated in your local area because that's your purpose, to serve your members or to serve your clients that you're supporting. The municipal bond portfolio allows you to diversify your geographic holdings by investing in areas that you don't necessarily serve.
I love that one, Alicia, real
yeah.
quick, is that it's funny because it's the same but opposite, right? You can support the local community that you're in, which you have to think about concentration risk.
Right.
You're already in that area.
Exactly.
Or you can get out of that area. It's not about support at that point. It's about diversification. And I just think that's so neat that you can have the same asset class provide two polar opposite.
Two different reasons. Yeah.
Yeah, exactly. Anything else we want to mention here?
Just the couple things on the con side. They're not pledgeable. From a piece size perspective, the piece size isn't necessarily up to us. We can't necessarily buy a $500,000 or $1 million piece size. If the maturity is only $250,000 or $260,000, we're limited to that smaller piece size. BQBLs do tend to be a much smaller than taxable. And we don't get to choose our maturity month. Michigan paper, for example, it has maturities that are May and November. That's kind of it. So any Michigan bond is going to be due in May or November, regardless of the year. And any municipality has their traditional month. So we're kind of stuck at that point.
All right, let's go on to our next asset class. Oh, actually, we have a curve before we get to the next
curve right
one.
here. Again, so the green line is the treasury curve, which is why I got confused on the other graph. The blue line being a AA taxable muni curve, and you can see that spread really widen out the farther we go. So definitely some value there in that taxable muni space.
All right, now let's go on. And we have corporate bonds. All right, so I love corporate bonds from the sense that, you know, these are a way, again, as a tool to grab yield, but there is a risk there. That's the credit risk. So I love them and I hate them, right? They're great. There's also that credit risk you have to be concerned about. But they cannot, like the US government, they cannot print money. They're not allowed to do it, turns out.
Why not?
Conflict of interest, I'd suppose. So when we're buying a corporate bond, we have to look at the soundness of the institution, their ability to continue to make those debt payments over a period of time, to share or to be able to hold the burden of overall debt that they have on the balance sheet, right? And then at the very end, we're going to get our money back, and that's called investment grade. How we deem something investment grade is measuring their ability to do that. So they're similar to muni bonds because of that credit risk. And a fun fact here for federal credit unions specifically, they can buy corporate bonds, but a very specific kind of corporate bond. We're talking about a bank note. And a banknote essentially is a corporate bond issued at the bank level of a bank, not the holding company, very specifically the bank level of the bank. It's deemed to be a little bit more secure, primarily because of the insurance that are associated with a bank there. Not to confuse that the corporate bond is insured. It's not, just to be clear. Now, these are 100% risk weighted, and yields are great depending on the part of the curve. You can go out there, you can see the blue line of corporate bonds really starts to widen out as you get into the 3, 4, 5 year. You can start to see that separation even further down. We don't spend a lot of time buying long-term corporates and standard portfolios, but there is an opportunity there, and even on the short end, a good pickup. So if we wanted to measure if this spread is actually good, we might want to compare it to an agency or a CD, and obviously the treasuries we're doing on this page. So pros and cons, very similar to munis. Again, we can look for spread with the credit risk component. We don't want to avoid credit risk. We just want to manage it, right? Just like when, as an institution, when you do a loan, similar concept. And we have a wide range of credit tiers to play in. Now, Alicia, for the munis, right? Going back to that for a second, what type of credit ratings do we typically see when we're buying a municipality?
If we're looking at a rated deal, we don't go any lower than single A. If we're looking at a private placement deal for a bank, it's not going to be rated. But we look at the credit internally. We deem it to be investment grade. And if it is deemed to be investment grade, then we will proceed.
Okay. Yeah, awesome. So on here for corporate bonds, it's a little bit different. We have more of a range. So we could develop a strategy, because again, tools in the toolbox, where we only focus on those high tier credits, meaning A's, AA, AAA, even that'd be kind of tough with the A's. Or we could go all the way down to the BBB and even BBB minus and still be within the scope of what's considered investment grade. So we have that little more of a flexibility than a municipality seeking the slightly lower credit for a slightly higher yield, or sometimes much more higher yield. Now, they're not pledgeable though, so that's something to be aware of. And large pieces can generally be found, but not always, right? So we're not going to necessarily be able to go buy a block of a $10 million corporate. Sometimes we can, but it's usually we're more in the 500,000, 1.5 million, 2 million, 3 million, that kind of thing. But the pieces are much bigger than what we could buy for, say, a CD, for example.
Absolutely.
And optionality is important to consider always. Sometimes the optionality that we have in a corporate bond is a little bit of fake news, I like to say, because it's callable the month before it matures. Not very material, right? And sometimes you see a longer type of optionality that you really do have to be aware of. Alicia, like you mentioned, if there is a call, let's say a maturity is 5 years, and it's callable a year from now, there's 4 years of uncertainty there.
Absolutely.
Right. So those are something that we want to be aware of as well. So MBS and CMO, let's keep on moving here.
Yeah.
This is the deep end of the pool that I got thrown in when I started working with McQueen. So these are near and dear to my heart. First asset class that I learned from you, Miss Bradley.
It was. We learned from that, by the way.
I didn't quit. Now, these are really actually much simpler than they may seem. At least when it comes to the MBS perspective. So let's break down what this is. Essentially, we're buying a security that is full of a bunch of underlying mortgages. So let's start with MBS, mortgage-backed security. We are buying a pool of mortgages when the people that own those mortgages make principal and interest payments, or if they completely pay off their loan. Maybe they move, sell the house. Maybe they refi if rates ever get low again. And that cash that they pay flows through, it passes through the investment into the investor. That's why we call it a pass-through. Now, a CMO is a bit more complex, but we start almost with the same structure as a mortgage-backed security, but then you actually structure it, meaning that different investors, I like to think about it, there are different parts of the line. There are people that are at the front of the line. So when those principal and interest payments come in, they get paid first. And there's some people in the back of the line, they get paid last. Maybe everybody in the front of line needs to get paid first. They step out of line and then it's your turn. Or maybe there's a CMO structure where certain investors only get paid interest. There's a lot of ways to slice and dice this. And one of the real benefits of a CMO is because of that structure, we can control a little bit more how that asset might behave in various scenarios. So pretty neat asset class, just scratching the surface on it. They're 20% risk weighted and 0 risk weighting if you did purchase a bond, a mortgage backed through a Ginnie Mae organization.
Yeah.
Anything else to add on that?
Yeah, the one question for you. So
Yeah,
on
absolutely.
CMOs, you specifically mentioned that an MBS is a pool of residential mortgages. Is a CMO also a pool of residential mortgages?
There are residential mortgages there, but is there a nuance that I think you're getting at?
It's a pool of pools. So that
Ah.
CMO is going to be made up where your MBS bond is going to be one pool of 100 loans. Your CMO could be 5 pools, each made up of 100 loans, or maybe 5 of 20 to get you to 100. But it's going to be a pool of pools. That's the only thing I was trying to just to clarify.
And when you look under the hood, sometimes we pull these up on Bloomberg, there's a lot of pools.
So yeah, so sometimes it's 7 or 8 screens deep because it's all pools of pools of pools of pools.
It's kind of like a Russian nesting doll sometimes,
Yes.
right? A pool within a pool. All
Great
right.
analogy.
So we have things to consider, and this is super important right now because some of you might be thinking, hey, is it a great time to buy mortgage backs? Yields are up, right? The mortgage back, the underlying mortgage has high interest rates. Great time to buy mortgages, right? Well, there's things to consider.
Well,
Maybe not. Maybe not.
maybe not.
Yeah. So we'll give our bias. We're not shy. So prepayment risk is something you really have to be careful about right now because you're looking at buying a mortgage-backed security. If rates fall from here, they can't get much higher, fingers crossed. And if rates fall, what do you think is going to happen to all those people that own those mortgages?
We're going to see a repeat of what happened during COVID. Everybody is going to refi.
And then what that means is when they're refining, those mortgages get paid off and that cash flow comes back to us faster.
Much
and
faster.
it's happening in a falling rate environment, right? So now we have all this cash coming back to us. We have to do something with it. You're going to lend it out at a lower rate. You're going to reinvest it at a lower rate. That is a big component of prepayment risk.
Yep.
Now, we mentioned double-edged swords a few times. Here's a great other opportunity to bring that analogy up is extension risk. It's the flip side of prepayment risk. And we really saw this going back to 2020. It's funny how the last 3 years are just perfect setup for this conversation.
They are.
So we should tell us what happened to mortgage rates in 2020.
In 2020, they plummeted. Just fell to the floor. It was late 2020, but they fell, and that falling of mortgage rates gave us that prepayment risk. So having those conversations of how fast is this bond going to prepay? We don't expect mortgage rates to move significantly. And then all of a sudden, everything no one anticipated to move, all came prepaying significantly fast. So on the opposite end of that, though, is the extension risk. So the loans that were available to purchase during COVID are 15-year 1.5s, 15-year 2s, 15-year 2.5s.
And those are coupons that you're referring
coupons,
to.
Yep. So those coupons are now out of the money to refi because why would you refi from a 2.5% mortgage to a 7% mortgage?
Because rates went up.
Exactly. So there we have our extension risk because I'm not going to get rid of my 2.5% mortgage to move into a house that I'm not only going to pay double for, which is a whole nother conversation for another day, but I'm going to pay double for the house, but I'm going to double or 2.5 times my mortgage payment. So then you get extension risk because there's no incentive for your buyer to make an additional payment on that mortgage because they know mortgage rates are so high and they don't anticipate them to come down. So it just shifts the weighted average life of your individual bonds, which then shifts the weighted average life of your MBS portfolio as a whole.
Absolutely. So a lot to consider here, and really quickly, a few other things. If your internal loan portfolio, what you do in your normal course of business to your customers and your members, if all you do is mortgages, maybe be careful over here with the mortgage-backed securities. Yeah. If all you do is commercial or auto, it's a great opportunity to diversify. We also want to consider geographic concentration. People tend to live on the coast. Turns out people like oceans. Who would have thought, right? So when we look at buying these investments, we don't want to be 100% in California, for example. Some
Right.
concentration's okay. Loan count, here's a great one. If you bought a mortgage-backed security and it had one loan in it, that's a crazy situation. It could pay off tomorrow. Maybe that person moves. Maybe, a lot of different things could happen. We want hundreds, if not thousands of loans. And what happens is a few prepay, various circumstances, no big deal. Smooth cash flow over a long period of time.
Yeah.
And you mentioned 1.5s, 2s, and all those numbers there. Those were coupons that we're talking about, which is the coupon we're getting paid. And it also is usually pretty close to the actual underlying mortgage rate of the actual mortgage holder.
Yeah.
So what are the pros and cons? The pros are great spread. Oftentimes they are pledgeable, big old piece sizes that we can buy, amortizing cash flow, a constant stream of cash flow that can be very helpful operationally, just having money coming in continuously to do loans, to buy other investments. And pro concentration risk sounds like a negative, but as mentioned before, we can move away from our current concentration, right?
Yep.
And then all these risks we've already mentioned. I won't belabor the point. Tails, let's mention that.
Tails
So
is the only
tails
one.
is a fun one because, well, Alicia, what's a tail? Define that for me.
Well, I mean, I guess it depends on the kind of dog, doesn't it?
Some of them don't have tails.
Some of them don't have tails. A tail in the mortgage portfolio is a small piece of a bond. So for example, if we buy $1 million bond today, over the course of the years, it's going to pay down through P&I payments. But let's say it's a 15-year mortgage. In 10 years, there's a handful of mortgages left. The original face that we've purchased of $1 million translates to a current face. That current face is down to $150,000. Sounds like one mortgage. It might be 50 mortgages. It might be 500 mortgages. It depends on what the original value of those mortgages are. So we have this small piece of a bond in a portfolio. Most of our premium, if we had premium, is amortized down or we've accreted back up to par. So we're getting a solid coupon on the piece. But it's going to be in the portfolio for another 5 years and it's going to continue to get smaller in size. So what we like to do then is we'll do a portfolio cleanup. We'll look to sell all of those smaller piece sizes and move them out of the portfolio because from a value standpoint, it doesn't make sense to have, let's say 10 pieces that total $100,000 if we can have one piece that's for $1 million.
Consolidate it, clean it up.
Yep.
When we look at a screen and we look at a graph of cash flow, if it falls off and we have a little bit of cash flow going on forever, that's a tail.
That's
I
tail.
call it a brontosaurus tail, if you can visualize that, right?
Dinosaurs, it's the theme of the day. It's the second time I've heard that today.
All right, so CMBS, a lot here, but I think a high level view of what is a commercial mortgage-backed security?
It's exactly what it sounds like. It's a mortgage-backed security backed by commercial property versus residential property, except on a MBS, we just don't put the R in there. Sometimes you hear it referred to as RMBS, which is residential mortgage-backed security. We drop the R, but when we're talking about commercial, we add the C back in to make it CMBS. And all they are is commercial mortgage loans securitized into a bond, just like a traditional MBS. Freddie Mac and Fannie Mae have a couple of different programs that they use to put these loans into bonds. The most popular Fannie Mae program is the Fannie Mae DUS program. Zach made mention on the prior, and we were talking about MBS, about how we only had, a pool with one loan. If that loan pays off, well, your pool is gone. That's what a Fannie Mae DUS loan is, though, or Fannie Mae DUS bond. It is a pool securitized by one loan. However, the amount of that loan is significant. It tends to be somewhere between, I'm going to say 5 million at a minimum, and I've seen them upwards of $35 to $50 million because they are securing typically large multifamily properties, so very large apartment buildings or apartment complexes where there's multiple buildings. Freddie K has a similar program, except it's multiple loans, and then the FRESB is essentially the same thing as a Freddie K, except the loans are much smaller in dollar size compared to a traditional Freddie K program. The nice thing about CMBS bonds for our bank clients is that they can be CRA credit eligible. So if you need CRA credit, you have a CRA exam coming up, you have the potential to earn that CRA credit on those loans within the bond themselves. And just like a mortgage-backed security or an agency bond, they are 20% risk weighted. There are some Ginnie Mae CMBS, which are 0%. However, they tend to be significantly longer for any of the portfolios we manage.
Very good. So what are the pros and the cons?
They match our MBS pros and cons, with the exception of tails isn't on here. Tails would exist for any of those. So we have prepayment penalties. So with Fannie Mae bonds, we have something called yield maintenance. So the borrower has the option to prepay their loan at a certain date and time. And dependent on when that date and time is, there's a prepayment penalty that gets passed back through to the buyer. So our client or the investor. Dependent on the term, sometimes there is a prepayment penalty, sometimes there's not. And on the Freddie K and the FRSB stuff, there is no prepayment penalty. That I shouldn't say that. Let me rephrase. There is a prepayment penalty, but it goes directly to Freddie Mac. It does not get passed through to the investor in a similar fashion that the Fannie Mae ones do. So that has the potential to be a con, because while it sounds like it's extra cash flow, which in essence it could potentially be, if the premium or discount isn't being amortized or accreted properly, it could come down to you owe or you have in your portfolio a book value of $345,000. After the prepayment penalty, the principal payment back is only $330,000. You have to eat the remaining cost. Simple as that.
Sounds like a lot of analysis needs to go into these types of investments.
Most definitely. They're not as vanilla as a treasury bond.
So there's some sprinkles in there, you might say.
These are multicolored, different kinds of sprinkles.
Bring me back to my childhood days. I love it. And one more thing I'll mention on this, going back to the theme of the tools in the toolbox, I love how in certain circumstances, those prepayment penalties that you mentioned can be great, because that means that we are basically not expecting to have that come back to us at any given time. And then most likely, if it does prepay, it'll prepay when that window opens up. The prepayment penalty is no longer there. And then in that case, commercial mortgage-backed securities in that example can act a lot like an agency.
They do.
Or treasury, and very different than than RMBS, residential mortgage backs, even though their names are so similar, they can act a lot different.
Yes, absolutely.
All right, so we are nearing the end here. And just to make sure that we leave enough time, we don't have people hanging on after the hour, we're going to make this next section a little bit brief. And you can go back and read some of the fine-tuned detail. So let's look at portfolio duration. And what exactly are we talking about here, Alicia?
All right. Sorry to read from the slide. Duration is a measurement of sensitivity to a change in interest rates. It is not average life. A lot of times we get confused that duration and average life are the same because the numbers are similar, but they are in fact not the same. Duration takes into account the maturity of the bond, the yield, the coupon, and the call feature. Weighted average life is simply a point in time at which we are anticipated to have half of our principal dollars back.
I hate this word, Alicia. Make it no secret. Duration, I think of time.
I do too. I do
time.
too, because what's the duration of the meeting? It's 30 minutes.
There you go. We need to go back in time and tell this person to change what they called those. It's hilarious. All right. So why do we care about duration? Why is it important?
It's important. It's important for a lot of reasons, but given the amount of time that we have, the higher the duration of a bond, the longer, or the higher the duration of a portfolio, we'll look at a big picture, the longer the portfolio's weighted average life. And then consequently, I'm taking the word right from the slide, I apologize, the longer that average life, the higher the price sensitivity of the portfolio. So while they are very similar to weighted average life, they are in fact different. That higher price sensitivity or that larger duration number can result in larger shifts in our market values as the portfolio reprices and as the market moves in either direction. So if we were to buy a 10-year bond and the market drops significantly, that bond holds a significantly larger premium than a bond that we own that has a 2-year duration, or vice versa. If the market were to move in the opposite direction, it could devalue significantly more than a much shorter bond.
And this reminds me of our conversation about SVB on the last webinar. And I think that they fell asleep during duration class because they they went into very long duration on the portfolio. Seemed great at the time, right? Getting good yield.
Right.
Problem is rates went up.
Yep. Duration. And went up quickly.
Yeah.
Yeah, and which extends the duration and it causes the devaluation. Exactly.
So they are tied to time. So there we go.
Absolutely.
All right. We're going to skip over this page for just lack of time. And then let's get into right here, price sensitivity. A few examples, Alicia.
Yeah, so this is the best way to explain duration. I tend to learn from doing, and sometimes doing is looking at a picture. So how much does the price of our bond change as interest rates fluctuate? So in the scenario there in the left, we have a 1% rise in rates. We're assuming in both of these scenarios that we have initial investment of $1 million. So a 1% increase in rates on a 1-year bond, that duration changes by -1%. On a 5-year bond, -5%, and on a 10-year bond, -10%. So we can see the corresponding changes in market value there. That 10-year bond becomes worth significantly less than that 1-year bond, even though we only went up 1%. Now, on the flip side of things, as rates drop, that 1-year bond has a change of a positive 1%. Skip down to that 10-year bond, the change is a positive 10%. So the market value increases significantly more, and it has to do with that duration or time of the bond to maturity. Again, I hate using the word of a definition in a definition while we're trying to explain something. So this example here gives 2 different scenarios, both an upwards rate scenario and a downwards rate scenario. And you can see the percentage change as well as the market value change on that initial investment.
Excellent summary, Alicia. Great job. And I
Thank
think
you.
one of my takeaways is that duration can be your friend or your enemy, right?
Mhm.
So this is an example of that. Great illustration.
Absolutely.
And now we're going to land the proverbial plane and talk a little bit about a summary here and a quick recap. So we talked about diversification. That's a tough word. It's key. So asset classes, we use different asset class to limit our risk in any given sector.
Yep.
Term, you mentioned a lot about term. We didn't really show a picture of a ladder, but it's important to know that we want to build a strong ladder. And term is a way to do that so that we don't have all of our money coming back in a year or even necessarily a quarter.
Right. We actually do show ladders. It's just in the duration section.
We
We talked a little bit too long.
Go back. Here you go. It's an Easter
Yeah.
egg for somebody to find later. So very important. And cash flow is a part of term as well.
Yes.
You know, we can build that ladder. We have static maturities coming out, and then we have cash flow coming out throughout the entire ladder. Those can work really hand in hand. And then finally, risk. Holistic balance sheet management is incredibly important. Investment strategy cannot exist in isolation. If you have an investment strategy and you're not thinking about it in terms of your balance sheet, your ALM risk position, there's an opportunity there. There's an opportunity to put those hand in glove. For example, if your risk position shows that if rates rise based on your loans that you have on your portfolio, maybe you have a bunch of long loans, your sensitivity is pretty high. Well, you know what? We can offset that with shorter term investments. We want to be careful about adding longer term investments. That's just one example. These are the types of conversations that we can have together. We can help you with that. Very important. Anything else that we can say to summarize here, Alicia?
No, I think you wrapped it all up. I think one of the big pieces to all of this, even if you diversify amongst different asset classes, you don't, to use your phrase, put all your eggs in one basket. I use that phrase a lot, actually. You diversify amongst your asset classes, you build your ladder appropriately. It is that holistic balance sheet management approach. If you have a whole internal loan portfolio of residential mortgages, we don't want to add exposure to residential mortgages in the investment portfolio. We want to make sure that that risk is diversified on both of the large asset pieces that make up our assets overall. So working with an advisor who understands your balance sheet, who is going to put that strategy together, knowing what the rest of your balance sheet looks like from both an asset and liability perspective is extremely important.
You know, and your last point signaled one last point for me is that we'll help with further education on this as well, right? This is not even though it's 201, this isn't a 301. There's the rabbit hole goes deeper. Craig, anything to add here?
A couple of things, actually. You guys
Great.
are doing absolutely fantastic. Couple of silly things to address is a Bourbonnais would be my favorite dog without a tail.
Oh, that's a new one for me. Cool.
There you go. And a Snorkosaurus would be the second. And that's not a real dinosaur, but it was the Flintstones pet dinosaur. But then more on a serious note, you guys did a great job. And I liked some of the closing summaries because a lot of people think about investments, and you guys covered this very well in 101. And a reminder for 201 is because this is where it really starts to click for people that want to go to the 301, investments 301 is the investment portfolio is a tool. And you guys just talked about that. It's a tool to manage your whole balance sheet. We can decide what happens with the duration of this investment portfolio. Not the, if chosen correctly on types of securities, the market can't dictate that for us. We choose it. Whereas if we have a lending portfolio, we don't have a lot of control over how our borrowers behave. Hopefully they pay us back, but the speed at which we can't control that. So there's that variable component that we can't control. And on the same thing on the liability side, you guys did talk about SVB last time and this time as well, which is great. The investment portfolio is a tool for us, and we have to really think about it from an ALM perspective, an entire balance sheet. So well done there. In the CMO section, there was a question about, some people say, ooh, CMOs are evil, right? Because there's some people that just say, are all CMOs evil? Can you just talk just a little briefly about that?
You want to talk about that? You want me to talk about it, Mr. Riley?
I'll touch on it briefly. I think the biggest elephant in the room is, we've all seen the movie The Big Short, or we've heard about it. And what they're dealing with back then in 2008, we're talking about non-agency products, right? CMOs and mortgage-backed securities. So when you look at the types of products the investments that we're looking to employ, these are backed by agencies. So no matter what happens, up, down, left, right for prepayments or all the interesting structures that can happen within a CMO, at the end of the day, the par is guaranteed by the agency. And that's a really big distinction. Alicia, anything to add to that?
Part of it too is knowing what you're looking at. Sometimes Mr. Whaley and I will look at a CMO, and I specifically asked, are they pools of pools? It may be a pool of pools, and that second pool is a pool of pools, and it's so on and so forth. And we are 8 to 10 pages deep in a loan that is pools of pools of pools of pools, and I'm not going to go on. But it's really being able to look at, to know what you're looking at, to know where your cash flows are coming from, to run the different stress scenarios. If this bond, here's what Bloomberg anticipates it to pay today. Here's where we think it's going to anticipate today based on where rates are and where we think rates are headed. If Bloomberg is wrong and we're wrong, what does the bond look like? Does it have a really, really long weighted average life because it has a really long stated maturity, and then we end up with a lot of tails, or a really large piece that just isn't going to prepay based on the structure of the CMO? Or is it going to play incredibly fast because we are the first person in line to receive our principal and interest payments? So it's knowing the type of CMO that you're getting into, knowing the structure features that are on that individual bond, and then stressing that bond in multiple scenarios, fast and slow, to know what it looks like in several different interest market rate environments.
Beautifully said.
Yep. Very well said. And it can be just formed the way that we want it and performed the way we want it. So they're not all evil is what I basically heard.
Yeah, no, they're not.
Yeah, excellent. We did have a question that came in about copies of the presentation. I answered that directly to the question, but I want to let everybody know as a reminder, we will be able to send the presentation after. Please just reach out. We'll send it to your advisor. We'll send it to you or to Corey or onto our website. It will be loaded onto our website as well under our YouTube channel under webinars. Any closing remarks before I give a little talk about our next webinar coming up?
No, I just want to say thanks to Zach for doing this webinar with me today. Hopefully all of our clients are able to get a little bit further education out of it today.
Had a great time, Alicia, and I think let's see how high we can get these numbers going. Let's do investing 601, 705. We'll see how high numbers we can go there. I can't wait.
Oh, that's fabulous. All right, so on the next slide, I believe we have the thank you. We do appreciate everybody that's in attendance. This is not a closed community. You guys are welcome to share our webinars with the rest of your staff and management. Please do. We do have an exciting webinar coming up in, a little under a month away on June 15th, 2 to 3 o'clock, and it's about our mid-year economic update. As everybody knows, we do a twice a year economic update, sometimes a 3 if there's some crazy things going on. But it's going to be on June 15th from 2 to 3 o'clock Eastern Standard Time. You can sign up from somebody's email and the email link, or go to our website, and has the webinar section there. We've got I really encourage people to go to our website, because we've rolled out a new one this year. There's a lot of new stuff there, and you can surf around and have some great interaction with it. So please, if you want to attend, register. We appreciate everybody attending today. Zach Whaley, Alicia Bradley, excellent job. Thank you for all of your knowledge and insight on investments.
Thank you, Craig, for
Absolutely.
hosting, and thank you for everyone that joined us today. Really appreciate it.
You're welcome. Okay, everybody have a great day. As it's 3 o'clock. Have a great day,
Let's go
everybody.
get some
Thanks
sunshine.
again.
Bye.